Welcome to the continuation of our business units part 4. I would like to take this opportunity to let you know that we are now on this app, Pathfinder. So this is Zambian app which you can use in case you are looking for a tutor for a specific subject. Okay, so once you go on the app, you're going to find various tutors with sample lessons. You can take a look at the lessons and choose the one that you're going to like. Hopefully it's going to be us. With that said, let's get started. By the way, you can check the link to the app in the description. Okay, so far we have looked at introduction to business units. We have looked at sole trade. We have looked at partnership. We have looked at private limited companies. We have also looked at public limited companies. We have looked at multinational companies. We have looked at public enterprises. Okay, so to finish this part, we're going to take a look at capital of a company. Okay, so what is capital? Okay, without considering capital of a company, just capital itself for a business, for a sole trade, for partnership, for all types of companies is defined as the amount of financial resources a company uses to operate and grow its business. Okay, so what about for companies? Okay, for companies, capital is raised through the sale of shares. Therefore, we call it share capital. Okay, so let's picture this situation. Okay, you and I, well, we want to start a business of selling power banks. Okay, we have gotten information that one power bank, the order price is 100 kwacha. So we have decided to start with 2 power banks. So we need 200, right? But of course, to factor in the unforeseen, maybe at some point we may need to grow the business, or we may need just money to be laying around for other things that we don't know now, but we may know as time goes by. So we can say maybe we need to look for 300. Okay, so the total amount of money that we want is 300, but maybe the one that we want now, it's 200. This one maybe later. Okay, so this is the amount of capital we want, but we don't have this money. So what we're going to do is we're going to sell shares, right? So we are going to say one share is 100 kwacha. So if a person buys one share in our company, then they have to pay 100 kwacha. Okay, so we're going to issue out these shares to the potential shareholders. Okay, but maybe this one we're not sure of its usage yet. Okay, so the way it works is if you issue out shares and some people are interested, they get the shares, they buy the shares, they give you the money, so they have shares in your company. Okay, for example, someone buys one share, which is 100 kwacha, so your company is going to have 100 kwacha. They have one share in your company. Okay, so as the company is operating, these people are supposed to benefit from the profit, and sometimes even not from the profit. Okay, they're supposed to be getting reward for their investments. Okay, that reward is called dividend. So the amount of money that shareholders get from the profits of the company is called dividend. So they buy shares and they'll be getting dividends. Okay, so that's how it works. So one would argue, why can't we just sell all the shares? Remember, this 100, for now, we don't know what to do with it. So if we give it out to shareholders, they would want to start getting the dividend. But if this 100 that they have given us is not going to be used to make money, then where are they going to get that profit? The company will be making a loss, because that dividend is going to be gotten from these hundreds that are working. Okay, so in short, what I'm trying to say is as promoters are coming up with the capital, they may have a certain figure which they may not need at that point. Okay, then there is also a figure that they need that one is going to be issued to shareholders so that shareholders can buy those shares and of course start benefiting by getting dividends. Okay, so this capital, that the whole of it, okay, that the promoters come up with is called nominal or authorized share capital. Nominal or authorized share capital. This is the total block figure that the promoters come up with. Okay, now only the 200 is going to be issued to the shareholders. So this 200 that's going to be issued to the shareholders is called issued or allotted share capital. Okay, now let's picture a situation where of these two, when shares are advertised, it's not always that all of them are going to be bought. Maybe someone does not, maybe people don't trust in the company, they don't think the company can make profit. So out of these two, only one has been bought. Okay, so there's just one that the shareholders have actually paid for. This one has not been paid for. So this one, which has been paid for, is called paid up share capital. Okay. Then finally, the one that remains, okay, is called uncalled for share capital. Uncalled for share capital, the one that is not issued out to the shareholders. So in summary, the total amount of share capital that the promoters come up with is called nominal or authorized share capital. Okay. Then the one that is issued out to shareholders is issued or allotted share capital. Okay. Then the one that shareholders actually buy is called paid up share capital. Then that one that remains is called uncalled for share capital. So let's just look at the definitions of all these. So nominal or authorized share capital, this is the amount of share capital which a company is authorized to issue as per its memorandum of association. So this has to be detailed in the memorandum of association. When the promoters are coming up with the memorandum of association, this has to be stated. Okay, so this is the nominal or authorized share capital. But remember, not all of it is going to be issued out to shareholders. So the second definition is issued or allotted share capital. This is the that part of the company's authorized share capital which is issued to the shareholders. As simple as that. Okay. The third is paid up share capital, which is that part of the issued capital which is paid up by the shareholders. Okay. So the part of the issued or allotted share capital that is paid up by the shareholders is called paid up share capital. Okay, and finally we have the uncalled for share capital, which is the remainder of the issued share capital. Okay, the one that remains, okay, that is the uncalled for share capital. I'm sure it's clear now. So now the company can call this the uncalled for share capital at any time in accordance with the article of association of the company. So the article of association states, okay, that this type of share capital, the company can call it or can use it whenever they need it. Okay, because initially it is kept for the unforeseen. For if we use the example that I had given. Next, we look at types of shares. Okay, so there are different types of shares. Okay, we have talked about different types of share capital, or how share capital is broken down. Okay, so we know that at the end of the day, the share capital has to be issued in terms of shares. Okay, so the shareholders or the interested or potential shareholders are going to buy those shares. Now, those shares may be different. Okay, remember we talked about maybe the company selling one share 100 kwacha. There were two shares, each 100 kwacha, right? So it can be maybe one share says that if you buy this share, meaning that if you give the company 100 kwacha and you have one share, every year you'll be paid the dividend. Okay, despite the performance of the company, you're going to be paid the dividend. Okay. Then the other 100 kwacha, if you buy it, it may actually be cheap. So not 100 kwacha, maybe it can be 80 kwacha. If you buy it, you're going to have one share in the company, but the type of share maybe if the company is not making profit, there's nothing you're going to receive. You can only receive something when the company has made profit. Okay, so the shares themselves are different. Okay, they're not always the same. They have got different characteristics or rights, so to speak. Okay, so the first type of share is called preference shares. So there are those type of shares which are entitled to some priority over the other classes of shares in the company. Okay, so these ones, they have got some special priority attached to them as compared to other types of shares. What does it mean? What are these priorities that they have? Okay, the priorities may include payments of dividends at fixed predetermined rate, or it may be repayment of capital when the company is wound up. Okay, so the first example, the first part of this sentence, the priorities may include payment of dividends at fixed predetermined rate. It means maybe that share, it says every year you have to be given 20% of the investment. Okay, so 20% has to be given to the shareholder every year, regardless of the performance of the company. Okay, that's what it means. Payments of dividends at fixed predetermined. So it's fixed. It doesn't matter the performance of the company. That 20% has to be paid every year. Okay, or it may be repayment of capital when the company is wound up. What it means by a company winding up, it means the company has failed and it's about to close. Okay, or the other way is, of course, liquidated or simply failed. So when a company has failed, like maybe it has accumulated lots of debts which it cannot pay, they may decide to close down the company. Now, the capital, maybe the vehicles of the company, the power banks that are still there that haven't been sold, they have to be turned into money and given to the investors. Okay, so maybe if you buy that share, you are going to receive your money through from the remaining capital of the company or remaining assets of the company. Okay, so those are the special types of priority. You get back your investment if the company fails, and the company is going to get your money from the remaining assets. Okay, so those are special types of conditions that may be attached to preference shares. So hope it's clear. So in summary, preference shares have got special conditions such as payment of dividend at fixed predetermined rate. Okay, where they are going to be maybe every year they have to be paying the shareholder a fixed determined rate. Okay, so we've talked about cumulative preference shares. So once you buy those shares, if the company is not making profit, or if the company is making profit, you're still going to be receiving your share as a cumulative figure. Okay, now the opposite is called non-cumulative preference shares. So these are shares given to shareholders who would then have a preferential right to receive dividends at a fixed rate, but don't have any claims on arrears of dividends if the company's profit is not enough to give out dividends. Okay, so there are two situations we need to consider here. When the company has made profit and there's enough money to pay out dividends, both the non-cumulative preference shares and the cumulative preference shares are going to be given the dividends. But when the company is not doing well and there's not enough money to pay out dividends, the non-cumulative preference shares are not going to be paid, are not going to receive dividends. Okay, but for the cumulative preference shares, they are going to receive dividends as a cumulative figure. Okay, and one thing they have in common is they both received a fixed rate. Okay, if it's 20%, they are all going to receive 20% if the company has performed well. But if the company has not performed well, these ones are not going to receive anything, but the cumulative are going to receive something. Okay, so that's a non-cumulative preference share. Then there's also what is called a participating preference share. Okay, so these are given to those who would then have a right to participate in the surplus profits of the company after satisfying the claims of all shares. Okay, so these ones, the participating preference shares, when the company has made profit, a good profit, first they'll receive the normal dividends they're supposed to receive. Then the part of the surplus profit, the demand that remains, they're also going to benefit. Okay, these ones, they benefit twice. They get first the fixed figure that was agreed. Then after that, they also participate in the surplus profit. Okay, so that the people buy these shares are called participating preference shareholders. So this will first get their fixed rate of dividend and then a share in the surplus profit, if any, along with the equity shareholders. So the other type of shareholders who also benefit that surplus profit are called equity shareholders. So these ones benefit just the surplus profit. Okay? The surplus profit is the profit beyond the normal. Okay? Also, they would also have a right to participate in the remaining balance of assets in the event of winding up of the company. So if the company closes, the participating preference shares are also going to benefit. The participating preference shareholders, that is people bought these participating preference shares, are also going to benefit in the remaining assets of the company. So that power bank that has remained unsold, these ones also would need to benefit. When it's sold, they are going to get part of the money. If it is not specifically mentioned, preference shares are deemed to be non-participating. Okay, so normally preference shares, they're not participating preference shares. Okay, so for a preference share to be participating, it has to be stated. Okay, so in short, if it's just a preference share, don't think it's a participating preference share. Okay, unless it is stated. So we look at the last type of preference shares, which are called redeemable preference shares. So redeemable preference shares are those type of preference shares issued with a condition that the amount of the shares will be repaid to the shareholders after a fixed period of time. So what it means is, if we go back to the example of the power bank business, so this shareholder buys one share at 100 kwacha. Okay, after 5 years, or when they are buying, there's going to be a condition in that share which says that after 5 years we are going to buy back our share. The company is going to buy back its share. Okay, so after 5 years, the company is going to give that 100 kwacha to the buyer. Okay, and they'll get their one share back. Then that buyer will no longer be the shareholder in that company. Okay, so those are called redeemable preference shares. Okay, the fixed percentage of dividend to be paid if there is sufficient profit until it is redeemed. So meaning that in these 5 years, from the time he has bought the shares to the time the company is going to get back its share by giving the person their money, the person has to be paid the dividend when the company has performed well. Okay, so within these 5 years, each year that person has to be paid the dividend if the company has performed well. Okay, but after 5 years, when we buy back our share, then that person will stop receiving dividends. Okay, so the company has redeemed its share, hence redeemable preference shares. Okay, so next we look at the second type or the second class of shares called ordinary shares. So these are what are at times called equity shares. The ones that I think I mentioned this while explaining a few minutes ago. So ordinary shares are also called equity shares. But what are they? So these are shares which have no preferential right. Okay, ordinary shares are shares which have no preferential right. That's the biggest difference between preference shares and ordinary shares. Okay, so ordinary shares, they don't have preferential rights. Well, preferential shares have got the preferential rights. I mean preference shares. Okay, so now the ordinary shareholders will get a dividend only if there is any balance of profit left after paying dividends to all the preference shareholders. Okay, so when there is profit, the first people are going to be paid. The first shareholders are going to be paid are the preference shares. If there is money remaining, that money is going to be given to the ordinary shareholders. Okay, so the first people are paid are the preference shareholders. If there is now money remaining after paying the preference shareholders, that money is going to be given to the ordinary shares. That's when they'll receive dividends. Also, there is no fixed rate of dividend. Okay, so all types of preference shareholders, there is a fixed rate of dividend, but ordinary shares, there is no fixed rate of dividend. Okay, in the event of winding up in the event of the company winding up, the ordinary shareholders will only get anything after satisfying the claims of the preference shareholders. So if the company fails, again, the remaining power banks, the remaining assets are going to be the money that's going to be recovered from there is going to be given to the preference shareholders. If anything remains, that's what will be given to the ordinary shareholders. Also, ordinary shareholders have voting rights concerning all matters and they're entitled to manage the company. Okay, preference shareholders, they are not entitled to manage the company. Okay, but ordinary shareholders, since they have to make sure the company is performing for the company to make profit so that they receive the dividends, so they have got voting rights and they are entitled to manage the company. In case the company fails, it means they have failed. Okay, but preference shareholders, they just waiting for the company to perform. Those that are willing to take risk and interest in the administration of the company prefer to be ordinary shares. Okay, so if you feel like you can manage this company, it's better become an ordinary share, not a preference shareholder. So I've mentioned that there are too many classes of shares: the preference shares and the ordinary shares. There is a third type, of course not a major class, but it's a third type of share called deferred shares. Okay, so in truth, there are three types of shares. The two main ones, of course, are preference and ordinary, but there's a third type of share called deferred shares. Okay, so deferred shares are generally issued to the promoters or founders of the company for services rendered by them to the company. Okay, so these ones are just for the promoters. Okay, they are not given out or they are not sold. They are just for the promoters themselves. Okay, so for the job they have done or starting the company and everything that they contribute, they are given what are called deferred shares. They are also called founders or management shares. The rights of the deferred shareholders will depend on the article of association and the terms of issue. So the documents are going to outline the rights of the deferred shareholders. Okay. So we've talked about capital. We've also talked about shares. We've talked about different types of shares: preference, ordinary, and deferred. Right. as the business is running, maybe there's need for money to expand the operations, to grow the business. So maybe sometimes money is raised by getting a loan. Okay, so we're going to take a look at what are called debentures. Okay, so what is this? So the definition is these are loans to a company. Okay, when a company gets a loan, it's called a debenture. Okay, so the characteristics include first, debenture holders are called the creditors. Okay, people are going to give out money, resources to the company, and are not buying shares in the company are called debentures. Okay, so because of that, since they are not buying shares, meaning that the company is not theirs, they are just giving out a loan. So debenture holders are the first to be paid the fixed rate of interest out of the company's profit before shareholders are paid their dividends. So when the company has money, first they pay out the loans. Okay, they pay the debenture holders. Then what's going to remain is going to be shared. It's going to be given to the shareholders. Of course, starting with the preference shareholders, going to the ordinary shareholders, and of course the deferred shareholders, depending on what is outlined in the documents. Debentures are repaid on fixed dates. Okay, so loans, if you are supposed to pay your loan on the 31st of every month, or maybe 31st December every year, then the company has to be paying on those fixed dates. The other characteristic is debenture holders do not participate in any company affairs. It's not their company. They're not part of the company, so they do not participate in any company affairs. Debenture holders do not carry any voting rights. Okay, like ordinary shareholders, they do not vote these ones. It's not their company. Also, they are quoted on stock exchange. Okay, so for a company, when it has gotten a loan, the people it was money, they have to be quoted at stock exchange. In Zambia, we use Lusaka Stock Exchange, which is going to be our next topic. Okay, so the debenture holders are quoted on stock exchange. Okay, so we look at types of debentures. So the first are called secured or mortgaged debentures. Okay, secured or mortgaged debentures are types of debentures which, when issued, a charge on the properties or assets of the company is created. Okay, so this statement, a charge on the properties or assets of the company is created, means that when the company gets that debenture, the creditor is going to state that if the company fails to pay that amount of money, it's going to get an asset of the company as a payment. Okay, so if the company fails to pay either the debenture interest is the more like the loan interest, or the principal. The principal is the actual amount of money that the company got on the expiry of the specified period as agreed when getting the loan. The debenture holders can recover the money by getting the assets. Okay, so now this charge on the properties or assets of the company is in two types. Okay, it may either be a specific or fixed charge or a floating charge. It can be a specific or fixed charge or a floating charge. So what do these two mean? So a specific or fixed charge is a mortgage of definite and ascertained property like specified factory building, machinery, etc. Okay, so what this means is a specific or fixed charge is a charge, okay, that is created on a specific item, an item that cannot just disappear or that cannot change, okay, like a factory, because the debenture holder or the creditor knows that the factory cannot just be sold easily. Okay, so they will be able to know that even if this company fails to pay me, I'll get that factory. Okay, so the charge that is created on such fixed certain assets of the company is called specific or fixed charge. Okay. Then the other type is a floating charge, which is a type which remains dormant. Dormant means not active until the lender intervenes or until the company ceases to be going concern. Okay, meaning that the company is becoming financially unstable or it's about to close or to fail. Okay, so this floating charge is a charge that can be issued on assets that keep on changing. It can be maybe money. Okay, okay, money may not be a good example. It can be it can be the same. For example, if we use the example of the power banks, it can be the same power banks. Okay, so the company can be if you don't pay the loan, we're going to get the power bank. Okay, so in this case, the company can be using that asset, but if the lender intervenes, if they want their thing, then the company cannot continue using it. Okay, or if the company seems to be failing, then the lender can come in and the company will stop using the property. I mean the asset. Okay, so the difference is for a specific or fixed charge, it's created on specific certain fixed items like machinery, factory, where a floating charge is for things that can, assets that can be changing. Okay, so that's the difference. Okay, so the other type of debentures are called unsecured or naked debentures. Okay, these are not secured by either a fixed charge or a floating charge. Okay, so this is where it's just a debenture has been given out, but no company asset is going to have a charge created on it. So they are also known as naked debentures or simple debentures. Okay, so unsecured, naked, simple, they are the same types of debentures. So the unsecured debentures debenture holders are treated as ordinary creditors on winding up the company. Okay, so I hope it's clear. Let's look at the difference between shares and debentures, because both shareholders and debenture holders, they give out money to the company. But what's the difference? So shareholders or shares are part of the company's share capital. Well, debentures, it's just a loan due by the company. Okay. The second difference is a shareholder gets dividend, debenture holders get interest for the amount of the debenture. Okay. The third difference is a shareholder is a member of the company, while a debenture holder is only a creditor of the company. Okay. The other difference is the rate of dividend received by a shareholder varies according to the profit earned by the company. So the rate of dividend received, it was supposed to be by here. The rate of dividend received by a shareholder varies according to the profit earned by the company. Well, of course, this is for ordinary shareholders. Well, the interest on debenture is definite and at fixed rate. Okay. The other difference is a shareholder is entitled to vote and can participate in the management of the business as directors. Okay, but again, this is for ordinary shareholders, not preference shareholders. Well, a debenture holder cannot vote or participate in management. Another difference is the share amount is not refunded except in the case of redeemable. Okay, the share amount is not refunded except in the case of redeemable. Well, for debenture holders, the debenture amount may be refunded after a fixed period. To finish this lesson, the last difference between shares and debentures is on winding up of the company. In case of shares, shareholders will get anything only after paying the debenture holders. Okay. Well, for on the other hand, debentures, as creditors of the company have first priority in getting their share upon the winding up of the company. So the company is about to be closed. First, pay the debenture holders. If anything remains, give that to shareholders. Okay, and of course, when it goes to shareholders, there are levels. There are preference shareholders. Then now you can look at these others. So that's those are the differences. So this marks the end of capital of the company. See you in the next lesson.